hardwired to notice risk. Our fear of the unknown can program us to fight, fly, or freeze. Hi, I'm Kelsey Davidson from BDA Financial, and I'm here to help you see past the negative headlines and look for opportunities in this uncertain time. At BDA Financial, we want to be part of your journey when you go through life. We want to help with planning, whether it's for retirement or legacy, tax management, or anything that may be important to you. That is why Bob and myself strive to educate you, our clients, on various topics. So without further delay, let's jump into investing in a market downturn. 8 principles and 9 opportunities to consider. Market downturns, market corrections, bear markets offer long-term investors some opportunities if you're willing to be courageous, counterintuitive, and keep a long-term perspective in mind. The first principle, owning stocks may pay off based on stock market history. 2, pullbacks and even corrections are to be expected. As Warren Buffett says, remember that the stock market is a manic depressive. For any consumer of daily financial news, this will ring true. Equity markets swing wildly from day to day, even on the smallest of news. It's important not to get caught up in the madness and stick to your long-term views. Which brings us to principle number 3. Keep a long-term view to protect your long-term goals. 4, higher rates do not mean the end to equity gains. 5, volatility often comes with raising rates and midterm elections. 6, non-recession bear markets are typically more shallow and rare. 7, market timers may miss out. Peter Lynch, who was the former manager of the Magellan funds at Fidelity, once said this about market timing. Far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in corrections themselves. And principle 8, make lemonade when you have lemons. Engage in creative tactics to increase your wealth. So let's explore each of these principles. Stocks have gained over the long term. When it comes to funding investment objectives, history has shown that there's no alternative to equities in providing better potential for capital growth over the long term. The market has overcome temporary setbacks of all kinds and continued to march ahead. This chart is a great visual that encourages you to zoom out and understand that U.S. equities have survived every setback, no matter how dire the situation may look in that moment. This graph only goes back to 2009, but you could go further to 9/11, to the Vietnam War, or even back to World War II. The equity market has fluctuated. It's gone up and it's gone down, but the overall trend line has been upward. If you're invested in the stock market, you're likely pursuing investment objectives that extend well beyond this year. Even so, note that it's paid to own stocks most years. The S&P 500 has had an annual return less than negative 10%, only 11 times dating back to 1926. That's almost 100 years ago. The S&P 500 has generated a positive return in 75% of the years since 1926. That's 72 out of 96 years. And 60% of the years results in returns 10% or greater. That's 57 out of 96 years. And lastly, 36 out of 96 of the years, or 37.5%, result in returns 20% or greater. But moderate pullbacks happen frequently, even in normal times. Even the healthiest markets have historically seen 3 to 5 drawdowns of at least 5% over the course of the year. We can look at this chart here from 1980 to March 2022 and see that pullbacks happen frequently. And with our pursuit for higher returns, there is investment risk. This chart is looking at the S&P intra-year declines versus calendar year returns. The bolstering points in the previous slides, even the best returning years for the market have at least one intra-year decline, with the average intra-year decline of 14%. So let's take 2020 as an example. We had negative 34% intra-year decline. That was with the COVID shutdown and sell-off in February and March. But we ended that year positive 16%. In 2009, you had a negative 28% intra-year decline, but ended the year positive 23%. Again, intra-year declines are to be expected. In addition, annual returns were positive for 32 of the last 42 years, which means you can count on two hands the number of years we have had negative returns going back the last 42 years. The longer your time horizon, the less frequent the occurrence of negative returns from stocks. The average 10-year rolling period posted positive returns for stocks 92% of the time. Those with greater than a 10-year investing time horizon have an excellent chance to achieve positive returns. In a letter Benjamin Franklin wrote to a prominent French scientist, he wrote the now famous quote, "The only two certainties in life are death and taxes." So we don't want to say that keeping a long-term view guarantees positive returns, but looking back historically, you have a very good chance at achieving positive returns. The investment time horizon is again another powerful tool for managing volatility. Again, the longer the time horizon, the stronger your opportunity for higher returns. For example, over a 5-year rolling period, a 50-50 portfolio, 50% stocks, and 50% bonds or fixed income could return anywhere from 1% per year to 21% per year. Obviously, stocks and bonds can be much more volatile during a short period of time, such as that 1 year. This is why we stress when we meet with people who are investing for the short term that you may not want to put your money in the market. For example, if you're saving to buy a house next year and you're putting money away towards the down payment, investing in the market is subject to risk, and that risk may outweigh that potential gain. If you watch the news or read headlines, you know that the Fed is starting to raise rates. You may have heard the term hawkish and that they're engaging in tightening of the money supply. After many years of a very dovish or accommodative policy, the Fed is raising rates, tightening rates, raising the cost to borrow money. Moving back to a more normalized position as far as interest rates go. Being at or near 0% interest rate is just not sustainable. Rate increases have historically not meant the end of stock market gains. On average, the markets peak 4 years following the first rate hike, with a median total return of 57%. If you look back at July 1975, the Fed hiked rates and the bull market peaked in November 1980, and the S&P reported a gain of 51% over roughly 5.5 years. The point here is, investors remain invested in the stock market in spite of interest rates increasing. Because ultimately, higher rates don't phase stocks. Here's a chart showing stocks in the year following the Fed's decision to raise rates since 1994. In the early days after the Fed's decision, investors often need some time to adjust to the reversal in the direction of interest rates. But in recent history of rate climbing cycles going back to 1994, only once were stocks lower 1 year later. This chart shows the 1-year performance of the S&P following the beginning of rate increases since 1994. In 4 out of 5 times, or 80% of the time, the market was positive. And the only negative occurrence was a loss of less than 1%. So in summary, equities should not be completely avoided during rate hiking cycles. Depending on where you are in life, depending on where you are in your financial planning, having some exposure to stocks can help hedge against inflation. As some of you may know, we're in the second year of a presidential cycle. And historically, the second year presidential cycles are the toughest. Here's a chart that shows S&P 500 returns and the drawdowns by presidential cycles. So as we know, or it could be happening now, the political ads are coming. This person's policies are awful, their background is awful, I'm a better candidate, so on and so forth. The rhetoric is beginning, and it's intensifying from both sides that things need to change. As a result, the second year of the 4-year presidential cycle is usually the most volatile, leading up to the midterm elections. The average intra-year pullback averages negative 6.7%, reflecting the increased level of uncertainty and volatility for the market. And markets hate uncertainty. So if you have a fair amount of uncertainty about who is going to control the House and the Senate, the market doesn't like that. In fact, going back to 1970, the second year of the presidential cycle has been by far the least rewarding for equity investors, averaging a 5.3 return, which is significantly worse than the other 3 years. So the bad news is we are in the second year of presidential cycle. But the good news is that year 3 is the strongest with the average yearly return of 18.5%. Markets historically love post-midterm periods. Markets love to get past those midterm elections. Here's the S&P 500 quarterly performance by presidential cycles. Going back to 1970, the second year of the presidential cycle has been by far the least rewarding and most volatile for equity investors. However, after this midterm election is in the rearview mirror, after that uncertainty has passed, after we know who controls the House and the Senate, history shows that the very best periods of equity returns have usually occurred. In fact, starting with the fourth quarter of the second year, the best 3 quarters on average of the 4-year presidential cycle since 1970 has resulted in the 3 strongest quarters in the 4-year cycle. So again, it's like a roller coaster. You're going to go down, maybe go through a spiral, and then start ratcheting back up. Historically, that's happened once we get past those elections. Now we're going to shift our focus a bit and look at bull and bear markets. This chart is going back to 1966. Stocks spend more time in bull markets. Bear markets have been relatively short, but can be extremely painful. There have been 17 bear or near bear markets since World War II. The average drop was 30% and lasted nearly a full year. This is the 3rd year of a current bull market, and the 3rd year tends to see somewhat muted returns, up barely 5% on average. Can the economy contract without the stock market having an especially negative reaction? Yes, sure. Recessions happen without bear markets, and bear markets happen without recessions. Non-recession bear markets are rare. Breaking down bear markets with recessions and without recession shows an interesting development. Should the economy be in a recession, the bear markets get worse, down 34.8% on average, which is not reflected in this chart. And lastly, nearly 30 months on average. That's the number of months to recovery. Only 3 times dating back to 1950 has a bear market occurred without a recession, and each of the 3 cases resulted in a relatively short recovery period, 7, 15, and 19 months. And very strong returns coming off the bottom, with an average return anywhere between 22.8% to 33.2%. So let me say that again. Only 3 times dating back to 1950 has a bear market occurred without a recession. And each of the 3 cases resulted in a relatively short recovery period with very strong returns coming off that bottom. Not surprisingly, the pandemics-related bear market of March 2020 was the fastest ever, going from a new high to negative 20% in 16 trading days. It was short and it was nasty. Market timers miss out, period. So many people I know, especially during COVID, are sitting there watching this bad news. First it was COVID, then it was news on Ukraine, and now it's people engaging in the guessing game of how many times the Fed will raise the rates, what those rate increases will be, or they're tracking the number of container ships still stuck offshore. Whatever you do, don't try to time the market. To time the market is to assume that you're going to get two decisions correct. The first, when to exit the market, and the second, when to return. More likely, you could get both moves wrong, and your portfolio will be worse for wear. Investors who missed 2020's 5 best days finished the year with an almost 18% loss. Compared to that stayed in the market enjoyed an 18% gain. If you missed just 10 days over the most recent 20-year period, you would have reduced your return by more than half. 61,685,000 compared to 28,260 based off a $10,000 investment. That's a pretty heavy toll to pay. Timing the market is more important than timing the market. A hypothetical investor who missed the 10 best days over the past 20 years nearly slashed their returns in half, 5.3% versus 9.5% if they remain fully invested. This is amplified by the fact that many of the best market days come off the heels of negative days, leading many investors to be stuck on the sidelines. Missing the 40 best days of the last 20 years would lead to negative return of 1.51%. Now that we went through the 8 principles of a market downturn, let's look at 9 opportunities. When the market corrects, it can be confusing, scary, and even frustrating. There are, however, opportunities in every market if you move boldly and if you move thoughtfully. The first key opportunity is to make your IRA and retirement plan contributions. Don't stop making those contributions because the market is correcting or is in a bear market. Why wait until the end of the year when you can make these contributions at a market low? Remember the proverb, to buy low, sell high, not in reverse. 2, always consider Roth conversions, as a market decline essentially provides a tax break, now on top of many other amazing benefits of a Roth IRA. Don't forget the backdoor Roth conversions as well. If you don't know what those are, give me a call or talk to your financial advisor. 3, consider your cash flow. Slow down or stop distributions until the market returns. This is where a solid plan B can come in. Look to alternative sources of income or open a home equity line of credit as interest rates are still relatively low. Consider cutting back on expenses for the time being. Maybe don't take that trip to Europe or go on that cruise or build in that screen porch that you want. Also confirm that your liquidity is still appropriate and that your emergency fund is in place. 4, if you were thinking of retiring, perhaps consider delaying that retirement until the market is stabilized. Yes, we've seen the big resignation, and apparently it's still holding fast and true. Although some people are returning back to work because investment accounts have taken a hit this year. Drawing down your portfolio at this time may slow the growth of your assets. 5, consider investing that cash that's sitting on the sideline. It does not make a whole lot of sense to depart from your emergency savings or other savings that you need for your cash flow. But if you have cash in your investment accounts, consider investing it. We will only know after the fact whether the bottom is here, but there's definitely a bottoming process going on. So perhaps consider dollar cost averaging into the market. 6, consider rebalancing your portfolio, whether that means selling overvalued and less desirable positions or rotating to areas that were previously hesitant to consider, such as alternative assets or cyclical stocks. You may also want to review your hedging strategies to ensure they still make sense. 7, with so many broad-based losses, consider tax loss trading also known as tax loss harvesting, as almost every portfolio has plenty of losses, whether it's in bonds or equities. However, keep in mind that the wash sale rule when selling equities. Don't get caught up in a tax situation. 8. Consider getting more aggressive with your asset allocation strategy if you have a long-term time horizon and a proper temperament to handle the volatile markets. And 9. Review gifting strategies in light of the declining market. Some strategies make more sense when assets are depressed, such as GRATs. They are grantor retained annuity trusts, in which the grantor locks assets into a trust from which they earn annual income. The beneficiaries receive the assets with minimal or no tax gift liability. You also want to review the impact of declining markets on a state if it's in probate and distributing assets. We are going to end with arguably the world's greatest investor, Warren Buffett. What he said is, the most important quality for an investor is temperament, not intellect. It's remaining calm while others are losing their heads. Remember to take a long-term view and not let your emotions, your fear overcome you. If you have any questions about what I've discussed or would like to speak with me personally, please visit our website, bdafinancial.com, and in the top right-hand corner, click Schedule a Meeting, or give me a call at 703-779-7410.